Joining us now is Mark Newton, Fundstrat Global Head of Technical Strategy. And one of the things we've talked about, Mark, is whether there's, dis irregardless. I think that's right. Regardless, irregardless, and you got to do it twice. So
double negative.
Right. Regardless of whether we try to put Humpty Dumpty back together right now, is there underlying damage that's been done, or is this all kind of within the realm of what happens when you see a break in the markets and it starts healing itself?
Yeah, thank you. Good morning, Joe and Becky. Look, I think there has been quite a bit of damage in the last 7-8 weeks. However, equities have pulled back to an area that is quite important. We have seen evidence of now volume dispersion that's been pretty significant, along with just breadth really being washed out in recent weeks. So there is some evidence that equities have in fact made a bottom and or in a bottoming process. Now, that doesn't mean that we move straight back to the highs. I think it's going to be a 2 steps forward, 1 step back type process, or really an L-shaped stock market probably for the next 30 to 60 days. So a lot of volatility. That's not going away anytime soon. But there are at least some technical reasons to think that markets have stabilized in the short run and can try to work a little bit better in the weeks and the months to come.
Like what?
Can I just ask real quickly, when you say an L-shaped market performance from here, you mean we've already drawn the first line of the L, the downside, and now we're going to bounce around, not that there's another down leg to come before we get there?
Yeah, we've seen some pretty severe deterioration, obviously, and now I think we likely could go sideways for probably another 1 or 2 months before starting a larger rally. So I think we've stabilized. Tough to see a V-shaped, in my opinion. We did see, obviously, a very good move on Wednesday, but as we saw yesterday, we've given it right back. But this area is very important. We've seen signs of technology really starting to stabilize. This past week, one of the biggest moves in Mag 7 off the lows. That's very encouraging. This morning's evidence of bank earnings is also very encouraging for the financial sector at a time when everybody thought they would come in poor. So I think, financials is the second largest sector, of course, within the S&P, technology being the first. And, a lot of the pessimism and sentiment with all this money moving all of a sudden from the U.S. abroad, I think is really ill-timed. We've actually seen the U.S. outperform over the last week over Europe and also out of Asia. Most of the world seems to be catching up at the time when the U.S. is finally starting to stabilize.
Are you able to talk about bonds and currencies as well, Mark?
Yeah, I think that the basis trade was something that was sort of interesting. That was certainly what drove, the POTUS and or Treasury put, so to speak, this past week. So, we had about $12 trillion of unwind in the equity market that was disregarded, but it really was a dislocation in the bond market. One of the fastest moves up in long rates that we've seen in almost 40 years that honestly caused action. And I think that's important because we haven't really seen that put thus far, and all of a sudden it materialized. So, very rapid rise, obviously in 10s, 2s, and the spread steepening. My thinking is that that's not going to be persistent. We're going to see rates start to come down really in the months to come.
How about sentiment? You just throw that out the window at this point, or how investors are feeling? Is it all held hostage by what actually happens with policy?
Yeah, sentiment has been bearish for some time. Arguably, that started to turn into capitulation almost earlier this week. So we saw not only traditional retail gauges reach almost the highest levels we've seen in 2 decades, things like fear and greed or AAII, but it really was, honestly, the downside volume that was so extreme that happened earlier this week. The TRIN and or the ARMS index reached 3.43, meaning almost all the volume was to the downside late last week, earlier this week. That was coupled by one of the best moves in advanced decline to the upside that we've seen in some time, like a 60-to-1 upside to downside ratio. So that's pretty convincing that we're likely trying to put in some type of a low. However, to your point, there has been a lot of damage done. This is not going to be a quick move back to new highs. This is going to take time.